I'm Stan Evans with Evans Wealth Management. Today's title is Investing During an Election. Like any big news event, U.S. presidential elections can cause ripples and even waves in the stock market. Changing your investment strategy in response to the market's short-term ups and downs can end up doing more harm than good. Here's a look at how elections can move the market and how to stay invested for the long term despite the short-term volatility. Generally speaking, elections don't affect the underlying trends shaping the stock market and the economy in the long term. These trends tend to continue across administrations after the White House changes hands. The rising stock market leading up to the 2016 election continued to rise in the months and years after the election, despite volatility on election day. Similarly, the unemployment rate was on a steady decline, and it continued to fall after the election. That said, new leadership in Washington can mean shifts in tax law, regulations, spending priorities, all of which could affect businesses. Here's how to stay invested for the long term. Number one, build a long-term plan and stick to it. Number two, focus on the big picture. The stock market downturns are a natural part of the market cycle. And three, avoid making emotional decisions. And number four is the most important part of it. Corporate America, the men and women running companies in this country, are very smart, adaptable, flexible, and make good decisions for their employees and shareholders. For these equity markets, these business leaders are far more important to this country than who's sitting in the Oval Office. Thank you for watching.